Welcome to this video from Kepsfield Academy. In our other videos, we introduce the steps required to calculate free cash flows given specific inputs. Today, we are going to explain how to build a financial model to forecast future cash flows. We will be exploring value drivers, fundamental tools that investors employ to project the financial future of a company. We will discuss different approaches to forecasting the income statement, balance sheet, and total cash flow. We will also illustrate how these projected financials ultimately serve as the foundation for calculating future cash flows that can be used in a discounted cash flow analysis. Value drivers are variables that influence a company's free cash flow and ultimately its value. Commonly used drivers in a simple financial model are revenue growth, gross profit as percentage of net sales, operating expenditures as percentage of net sales, the corporate tax rate as percentage of earnings before tax, net working capital as percentage of net sales, and capital expenditure as percentage of net sales. When building a financial model to support a discounted cash flow valuation, one key trade-off to consider is the choice of value drivers and the appropriate level of detail. The challenge lies in finding the right balance between simplicity and accuracy. The appropriate level of detail often depends on the industry, the company's operations, and the analyst's familiarity with the business. A model that is too simple might not capture the nuances of the business, while an overly complex model can be difficult to understand and maintain. In practice, analysts often start with a simple financial model, using only a few drivers and add more detail when and if needed. Numerous strategies exist for forecasting revenue, among which using historical sales growth as a prediction of future growth is a widely adopted top-down approach. A metric that is often used is the compound annual growth rate, CAGR. The CAGR is the average annual growth rate required to grow linearly from sales to first historical period under review, T-N, to sales in the last historical period under review, T. The formula for determining the CAGR for revenue is revenue in the final year T divided by net sales in the starting period T-N to the power 1 divided by N minus 1 minus 1. In this example, we divide the net sales of €800,000 by €500,000. This we exponentiate to the power of 1/4. We subtract 1 to arrive at a CAGR of 12.5%. In financial modeling, value drivers such as gross margin and operating expenses as a percentage of net sales are often used. These are referred to as value driver ratios. Once historical value driver percentages have been calculated for the historical periods, it is time to establish a view on future developments. Remember, this process isn't rigid. Just as when applying the average net sales growth rate, you may need to diverge from using averages if you have specific managerial insights. The same applies to the projection for net working capital and capital expenditure. In a simple model, this balance is often forecasted based on the ratio to net sales. We will go over this in more detail based on a case example. You have been asked to prepare the projected free cash flow for Availer Inc. for 2023 to 2027. Management has provided you with the following information with regards to expected results. Net sales growth is expected to decline from 10% per annum to 2% in a straight line over the next 5 years. The gross margin is expected to be 36.9%, in line with the average in the period 2020 to 2022. Operating expenses will remain stable at 4.1% of revenue, which is in line with the historical average. Depreciation is in line with capital expenditure as management expects to be able to support the projected net sales growth with the existing asset base. No amortization or impairments of intangibles is expected. Interest payments are determined by the level of interest-bearing debt on the balance sheet and the applicable interest rate. The expected corporate tax rate is 20% of the earnings before tax. Regarding the balance sheet, management has informed you that capital expenditure on property, plant, and equipment is expected to be stable at 12% of net sales, which mostly relates to replacement CapEx for existing assets. No investments in intangibles are anticipated. Net working capital as a percentage of net sales is projected to be 23.5%, based on the average in the period 2020 to 2022. Based on the assumptions, we first project the income statement. First, we calculate net sales based on the projected net sales growth, which decrease from 10% to 2% per annum. We arrive at a net sales of €21.3 million in 2027. By applying a gross margin of 36.9%, we arrive at a gross profit of €7.9 million in 2027. Operating expenses are calculated based on a percentage of 4.1% of net sales. We arrive at a total operating expense of €0.9 million in 2027. Based on these calculations, we arrive at an EBITDA of around €7 million in fiscal year 2027. Next, we are going to determine the items below EBITDA, starting with depreciation and amortization. In financial modeling, a corkscrew calculation is a method that is often used to forecast the balance of long-term assets or liabilities over time. This term is often used in the context of modeling property, plant, and equipment balances, along with associated depreciation. The corkscrew has the following steps. You begin with the opening balance, which would be the closing balance from the previous period. Next, you add any capital expenditures, which represent the company's investments in PP&E during the period. Then you subtract the depreciation for the current period. The result is the closing balance for the current period. This closing balance then becomes the opening balance for the next period, and the process continues, creating a corkscrew effect as the balance keeps evolving over time. We project capital expenditures based on a fixed percentage of 12% of net sales. As this mostly relates to replacement CapEx, depreciation is estimated to be in line with capital expenditures. Based on these inputs, the balance of property, plant, and equipment amounts to €16.8 million in 2027. Note that depreciation is forecasted based on high-level hard-coded inputs. In our more advanced courses, we will cover more detailed ways of forecasting depreciation. The depreciation we projected in the corkscrew flows into the income statement on the line Depreciation and Amortization. The property, plant, and equipment balances that we calculated in our corkscrew flow into our balance sheet projections. The remaining items below EBIT are interest expenses and corporate income tax. Interest expenses are based on the interest-bearing debt on the balance sheet multiplied by the interest rate. As debt is projected to remain stable, interest expenses are projected in line with the expense in the period 2020 to 2022. Corporate tax is calculated by multiplying the earnings before tax, or EBT, by the historical effective tax rate of 20%. Based on these assumptions and calculations, we now arrive at a net income of $2.7 million in 2027. Next, we are going to forecast the balance sheet. We start with the property, plant, and equipment balance from our corkscrew calculation. Intangibles are projected to remain stable at the year-end 2022 balance. Next, we are going to forecast net working capital. In our simple model, individual components of net working capital, such as accounts receivable, inventory, Other current asset accounts payable, and other current liabilities are not forecasted separately. As an alternative, net working capital is projected based on a percentage of revenues. This assumes that a certain level of working capital investments are required to support the growth of the business. Net working capital as a percentage of revenue is projected to be 23.5% of net sales, in line with the historical average. We now have all the components of capital employed, which is projected to increase to €23.3 million in 2027. Next, we're going to forecast the financing balances, starting with equity. The case assumes no changes in equity other than retained earnings. The equity balance is therefore calculated by taking the balance from the prior period and adding the net income of the current period. For 2027, we add a net income of €2.7 million to the equity balance per end of 2026 of €25.3 million to arrive at an equity balance of $28 million per end of 2027. In practice, changes in equity such as dividends are common and can be easily modeled using the corkscrew method. Forecasting debt is relatively straightforward since we assume all debt remains constant at the 2022 level. We have now calculated all balance sheet items except the cash and cash equivalents balance. To be able to calculate this balance, we need to calculate the total cash flow. Hopefully, financing will equal capital employed once we have included the cash balances in there. Let's see. Total cash flow is calculated based on the following steps. First, operating cash flow is calculated. The starting point is EBITDA, since this reflects the earnings before depreciation and amortization, which are non-cash expenses. Next, we deduct the income tax from EBITDA. Note that this is the actual income tax expense incurred by the company. We find this line directly from the income statement. Finally, we deduct the investment in working capital. An increase in net working capital leads to lower cash flow, and a decrease in net working capital leads to higher cash flow. Next, we calculate the investment cash flow. The investment cash flow is equal to the movement in tangible and intangible fixed assets on the balance sheet, plus depreciation and amortization. The calculation is explained in more detail in our other videos. Finally, the financing cash flow is calculated. We assumed the gross debt remains stable, and we forecasted no movements in equity other than retained earnings. We can now use a corkscrew to calculate the cash balances for each period. In the corkscrew, we add the total cash flow to the balance of the previous period to arrive at the cash position at the end of the period. It is important to understand that total cash flow is not the same as free cash flow, since free cash flow only includes cash generated by operating activities. Total cash flow includes cash flow from operating and non-operating activities, including financing. We can now use the cash balances we calculated to finalize the projected balance sheet. Luckily, we find that capital employed equals financing, and thus our balance sheet appears to make sense. Let's do 2 more checks before we calculate our free cash flow. The first thing we check is if the movement in the retained earnings account is equal to the net income in the period. The second sanity is if the movement in cash and cash equivalents account corresponds to the total cash flow. We can now continue to calculate free cash flow based on the steps that we have learned in our video on this topic. We find that free cash flow will increase to €3.5 million in 2027. Note that the difference between free cash flow and total cash flow is driven by financing items, in our case, interest and tax, since all other financing movements are assumed to remain constant. For example, in fiscal year 2022, free cash flow is €3,015,000, compared to a total cash flow of €2,135,000, a difference of €880,000, which is driven by the tax calculated on EBIT instead of earnings before tax, EBT, which excludes the tax benefit from deducting interest from taxable earnings and interest expense of €1,100,000, which is excluded from the free cash flow definition. Remember, free cash flow looks at the cash flow from core operations available to all financing providers, debt and equity. This is the cash flow before the impact of introducing debt in the capital structure of the company. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.